Someone is betting big, $9 million worth of short-term options that the VIX is going to see another big spike in September. A trader or a group of traders spent $9 million by buying roughly 350,000 VIX 22 to 30 September call spreads for $25 a piece, or 25 cents in option terminology. This is a pretty big bet. Each one of these options could pay out a max profit of $800 a piece. So this is a max potential payout of $280 million, which would be a pretty good return off of only $9 million. And really, whether or not this position is going to pay out or stocks are going to fall really comes down to this Friday's jobs report. And yeah, September, historically, is a bad month for stocks. So I wouldn't be surprised if we have a bad Tuesday, a bad Wednesday, a bad Thursday, and then everything is on the line coming Friday. Currently, NASDAQ futures are up 0.12%, S&P futures are up 0.07%, and Dow futures are down 0.05%, but we're not really getting any hints from futures what's going to happen this week. It's really not moving too much. Now, as you can see from this post by Zero Hedge, September is by far the worst month for stocks over the past 6 years, with an annual return in September of negative 4.5%. That's rough. That's bad for just a 1 month time period. Specifically, these numbers would look higher if you're looking at just the last 4 years. In 2020, you were down 5.16%. In 2021, you were down 5.31%. In 2022, you were down 10.5%. And in 2023, even, you were down 5.8%, which was, again, by far the worst month we had in 2023. So if this Friday's jobs report does not come in good, like strong, you're probably going to see some of this September seasonality come back and potentially catch markets by surprise. When in fact, if you actually just look at 2020, since 2020 until now, the 4 years, right? 2020, 2021, 2022, and 2023 Septembers, you're actually down about 6.7% on average the last 4 Septembers. So this is almost like a correction that you get during the month of September. This time is also a little bit more interesting because we do have the election coming up, and September is when you start to get some election pricing in, some election risk. And then to make matters even more confusing, the S&P has been coiling for the last really couple of weeks now. What I mean by coiling is a lot of back and forth price action in a very close range. It literally looks like a coil. And this doesn't happen too often, but when it does happen, you tend to get big moves to the upside or the downside. What you seen on Friday was the S&P that went up 0.95%, actually hitting a multi-month high, right? You have not hit as high as you did on Friday since at least July 16th, which was the all-time high. So you're actually looking pretty good on the charts. The markets look like they do want to go higher here, which makes the negative September seasonality, the election risk that potentially can start to get priced in September, just a little more confusing because markets look good, but these other issues are more negative. As David Marlin on X says, September is notorious for market dips, but the weakness tends to be backloaded. The last 2 weeks of September are the worst 2-week period on the calendar. And as you can see here, September is marginally worse. The second half of September is marginally worse than the second half of June. Second half of June tends to be pretty rough as well. And the second half of February also tends to be pretty rough. Other times, I mean, it's standout compared to other 2-week periods for markets. The difference about this September is the markets are focused intensely on economic data heading into the first Fed cut September 18th. Now, a Fed rate cut in and of itself is neither bullish or bearish. Okay, let's just be honest. Yes, there can be, bullish or bearish implications from that, but it depends why the Fed is cutting rates. Just because the Fed is cutting rates doesn't really mean anything. If the Fed is cutting rates to normalize Fed policy, presumably before a Fed error or before a recession, markets will look at that as great news. And that's why this September is so different, because prior Septembers where you've gotten these seasonal corrections, it wasn't really to do with the Fed cutting rates, right? The last time you've seen the Fed cut rates was 2020, and that was obviously way different than where the Fed is at right now. So if the economic data, if this Friday's jobs report comes in good or better than expected, the unemployment rate does fall as markets are pricing in, there's going to be a higher perceived chance of a soft landing. There's going to be more money coming into our markets. There's going to be more risk-taking behaviors, and that's going to be good for equity prices. And I think that's what's different from this September. Now, the biggest data point we get that the markets will be focused on is this Friday's jobs report. So while we will get other data throughout the month of September, if this jobs report is decisively negative, that's going to be decisively negative for markets really throughout the entire month of September. I don't think any other data is going to come out and save the soft landing narrative if unemployment goes up again, if the jobs report comes in low. Vice versa. If we get a really strong jobs report and the unemployment rate falls, I don't really think any negative data is going to outpower a good jobs report, if that makes any sense at all. And that's why this Friday is critically important for September. Now, as I have said in prior videos, I do think the economic data is lagged behind. I do think the economy is worse off today than what the data is representing. But with that lag comes, well, I think good data this month. I'm not worried about the jobs report this Friday. I actually think it's going to come in maybe a little bit better than expected. And that could cause a pretty bullish September. I'm more concerned about October, specifically concerned about November and December, because I think the economy today will start to be reflected in the data that we get by November and December. That's why, this lag it's delaying things a little bit. Even as you can see here, 90% of U.S. cities saw a rise in year-over-year unemployment rates in July, according to the BLS. Jobless rates jumped in 350 of the 389 metropolitan areas last month. Additionally, in 8 large metro areas with a population of 1 million or more, fewer people held a job in July 2024 than in July of 2019. So more people were employed in 2019 than in 2024 in 8 cities with over 1 million people or more. That is bad, okay? That is terrible. That is not a good stat you want to hear. At the same time, average weekly wages dropped in 43% of the 389 metropolitan areas. No wonder people are struggling. In 5 of the 8 highest paying areas with average weekly wages above $1,400, salaries declined year over year. As the Kobisi letter says here, the labor market is weakening. And I think that's true. I think that is very true. But I do think the official data we get from the government that markets pay attention to, it's not necessarily manipulated. I know some people have said, well, are you calling government data like manipulated then or cooked? Not necessarily. I just think it's lagged really bad. Like 3 to 6 months lagged. 6 months is more extreme. I think a 3-month lag makes a lot of sense based on what research I am doing on the ground, the people I am talking to, the contacts that I know. And long story short, that's why I think September, this jobs report is going to come in good, and September could actually be a pretty strong month for stocks. I do think not broadly for the S&P, because you have to remember big tech is negatively impacted by the Fed cutting rates and a soft landing. Like, why would you want to be in big tech if we go into a soft landing, the Fed starts to cut rates? There's small caps that are going to outpace the EPS growth of the S&P 500. You have high-paying dividend stocks and value stocks and cyclicals that are priced for a recession. You will see a re-rating in those areas, whereas big tech's going to take in less interest off of their cash as the Fed starts to lower rates. And if there's not as much recession fears, then why own big tech as a defense kind of trade for much the same reasons as markets have loved big tech as the Fed has raised rates, because big tech is not dependent on rates. Their customers don't need federal fund rates at a certain rate to sell their products, right? Microsoft, Google, Amazon, Apple, all these companies, it doesn't matter what the Fed does. The Fed doesn't affect their demand, but the Fed does affect demand in other areas and other companies and ultimately pockets of this economy. So for that reason, big tech's not going to benefit fundamentally from rates going lower. Presumably, you could say NVIDIA might benefit because some of their GPUs are likely going to be financed. Okay, sure, there's an argument for that. But big tech as a whole is actually negatively impacted from the Fed cutting rates into a strong or decent economy, aka a soft landing. So while I think September is going to be a great month for stocks, in my personal opinion, I don't think it's going to be on a S&P headline basis, although I do think the S&P will move up, likely hit a new all-time high. I don't think that's where the most impressive gains are going to be. With that said, let me give you a rundown of what we can expect for economic data this week. And starting off tomorrow morning, we have ISM manufacturing PMIs, expecting those to actually get a little bit better, but still be in contraction territory. ISM manufacturing prices is what a lot of people are going to pay attention to. You're actually expecting that will fall a little bit, but still positive, still seeing some inflationary pressures in manufacturing. At the same time, manufacturing has been negative in really a recession for over 2 years now. So that's another interesting dynamic. Wednesday, you will get the JOLTS job openings. This will be important. It's really a measure of economic activity, I think, more than the jobs market itself. Because if you're a business, let's say you're doing great, everyone just got stimulus checks and they're spending with you like crazy. You need to hire more employees. Your business is doing well. That's what you do. You hire more. Great. You're looking to hire 5 employees. Awesome. Now it's 2024. Your business has slowed down because people have slowed down their spending habits, and now you're only looking to hire 1 employee. That's 4 job openings that are gone now. Okay, it's really a sign of broader economic activity more than it is the actual labor market. I know people try to use the parity of unemployed people versus job openings, and this shows strength or weakness in the labor market. No, this data shows how the economy is doing, more broadly speaking. And the problem here is, I guess, only like 26% of companies actually report their numbers to the BLS when they hire or fire someone. So it's really just algorithms plugging in a couple hundred businesses, that report, and then trying to extrapolate that for all of America. So the data really is pretty inaccurate as is. But if you do see a big fall here, that's a problem. Wall Street's not going to like that. If you see a rise here, that's actually better than not. What you want to see preferably is just a steady 8 million or so. Last month we were at 8.18 million. We're expecting 1.1 million. So 80,000 reduction. Not a big deal. But let's say we did get 500,000 jobs that are no longer looking to be filled, then theoretically that would be a problem, and I think Wall Street would not like that. On Thursday, you will get the ADP employment change, expecting 115,000 net job ads. This is the private payrolls, not from the government. So keep that in mind. You will get initial jobless claims, expecting that to tick up to 235,000 from 231,000 last week. Not a big deal as well, as long as these are staying stable and not continuing to go higher and higher and higher like we've seen for a period just a couple of weeks ago. You will also get ISM Services PMI that comes out Thursday at 10 o'clock in the morning, expecting that to actually move upwards a little bit to show a little bit better activity in the service sector. And service sector overall, pretty close to going negative. So you want to see that come in strong, because the last thing you want is manufacturing in a recession, negative for over 2 years now, and then services to start going negative. That becomes a big problem. Now, Friday, for non-farm payrolls, you're expecting around 163,000 in net job ads. The higher, the better here, okay? Like, if we were to get 300,000 jobs that are added, markets would tear higher. Yes, that would mean less cuts from the Fed, but that would mean much higher chances of a soft landing. Now, if this comes in around expectations, call it 150 to 170,000, then I would expect markets would trade well on that, but it wouldn't be super negative. It wouldn't be super, super positive. But I do think it would be skewed more towards positive as long as that number does come in good. It's really about the unemployment rate. So the unemployment rate is currently 4.3%. Wall Street's expecting that will come down to 4.2%. If it stays at 4.3%, not really a big deal in my personal opinion, because it's all about what the rate of change, what's happening, right? And when the unemployment rate starts to go higher during a recession, it tends to keep going higher. And you've seen the unemployment rate rise now 5 reports in a row. If it goes up again for the 6th report, yeah, there's going to be a lot more recession fears out there. Even if it just goes up to 4.4%, God forbid 4.5% or something, even worse than that, you're going to rapidly start to price in a recession, like rapidly. What you've seen on August 5th would have been the appetizer. I would expect just within a couple of days to be back to those levels. If not, 2 days maybe. That's how extreme the pricing in of a recession would be. I mean, you could fall 5% or more. Let's be honest, just where the markets are and where we're, currently pricing in a soft landing, you could see a circuit breaker on Friday. If let's say the unemployment rate did tick up to 4.5%, I don't think 4.4% gets you a circuit breaker. A circuit breaker, for anyone that does not know, is if the markets fall 7% in a single day, the index itself is halted. Markets close down for 15 minutes. They open again. If the markets fall 10%, you get another circuit breaker, and they close for another 15 minutes. And if the markets fall 20%, then they close for the day. So I was actually wrong about the second circuit breaker level. It's actually a 13% decline. We actually hit that during COVID, where we got the 7% decline, and then almost immediately after we fell to 13%, got that decline, but avoided that 20% decline where you actually close for the trading day. And if you ever see anything like this, especially that 13% or more, that's basically like the world falling apart. That's a true black swan event. Could you see 7% of a decline on Friday if the unemployment rate were to really skyrocket? I would expect that, because markets right now are pricing in a 0% chance of a recession. But in all reality, I do think the unemployment rate is probably going to fall. We're probably going to come in line with estimates around 4.2% unemployment, and markets are probably going to love that for the month of September. At least cyclicals, values, small caps, interest rate sensitive companies. And that's my assumption. Again, could I be wrong? Yes, of course. And based on this trade that I showed you, this $9 million trade with a max payout of $280 million, I mean, that is pricing in what could look like a circuit breaker for September. So, I mean, take everything with a grain of salt right now. The only thing we know for sure is Friday is going to dictate the next 5 to 10% higher or lower at bare minimum in markets. So let me know what you think about this information down below in the comment section. What is your expectation for this Friday's report? I would love to hear that down below. You guys have a great rest of your day, and I will see you in the next one.